let's throw out this scenario. Someone that they love doing deals with. They've invested in a couple of their individual projects or syndications. They now need to evaluate, okay, I like this guy. Should I go into his fund? What are the questions that someone in that situation should be asking their favorite sponsor?
I'm always looking at it like what I just said. Do you think that you're actually going to see enough deals that look like this? I'm always, when I'm reading a PPM for like a blind pool fund, I'm looking for what's the mandate, right? With the investment mandate, meaning what can you do? What can't you do? And if it's super wide, then I'm going to be turned off. Like if they can just do whatever the hell they want to do, that's going to make me nervous.
All right. Welcome to another episode of the Legacy Wealth Podcast, where we help accredited investors build their legacy through passive investing. I'm your host, Pascal Wagner, and today we have on the show Lance Pederson, joining us from Houston. So I'm going to give a little bit of background on Lance. Lance is the co-founder of Resonance Industrial Fund, which was formed to invest in Class B industrial properties throughout the U.S. Heartland. Their objective is to provide high net worth individuals and small family offices with monthly double-digit cash flow, growth, and benefits of depreciation. He began investing in private investments personally in 2022, has invested over $2 million in over 8 deals as an LP. Jump in and dive in here. What does the U.S. Heartland mean? Like, first question off the top.
Yeah, exactly. Well, I'm from North Dakota originally, right? And so there's sort of a debate, where's the Midwest? What constitutes the Midwest? So for us, I'm counting the Heartland as sort of your Minnesota, Wisconsin, Iowa, Illinois, Kentucky, Tennessee, Missouri, Michigan, Ohio, sort of that. It's not the East Coast, it's not the West Coast, but it's not North Dakota, South Dakota, Nebraska, everything sort of Mississippi, the Mississippi River eastward, I guess so that's kind of that Heartland.
Got it. Is like when you say that, I mean, you're obviously raising money and do investors resonate with that, or is that just the term I'm unfamiliar with?
I don't know. I'll say Heartland. I'll say the Midwest. It's I like the Heartland. It sounds more hearty and parochial. I mean, I think that's why we like it. It's just that it's sort of those flyover states and the forgotten areas, but yet when you look at the waterways and the railroads and the interstate system, I mean, that's where all the goods are moving north to south, east to west, right? And so owning industrial property in those areas, is a great place to own them. And so, yeah, it doesn't come up very often, but most I'm sure think the same thing you do, but I kind of got a little slide in my deck that shows the states I'm talking about, but there's a 6, 7, 8 state area there that we kind of have a fence around.
Yeah. Look, before we got on the show, you talked a little bit to me about what you were doing in terms of advising clients and NLPs when they're investing in the space. I also want to talk about your the fund that you run and dive into the details of that. But let's kind of start from the beginning there. You talk to me and to our audience about this career of advising and getting into the alternative investment space.
Yeah, so I started my first company. I was like 20 years old. It was an IT company. In 2008, I got into real estate and on the hard money, kind of private money lending side. So that's how I got into it. We pivoted that business from lending to just more of a private equity real estate firm. So an allocator of capital. We raised money from high net worths and then allocated it to sponsors that were executing strategies that we liked and with operators that we thought were good. So I think we're really just sort of a super LP, and just have a little bit, more zeros behind our checks to kind of, throw behind us. But, professional investors, is part of that. We were investing with, your smaller, sponsors. These aren't huge institutional or GPs, right? And so the problem we ran into early on was just notoriously really bad at back office reporting. And we had a fund of funds And that was creating some major problems for us because we couldn't report, our results without theirs. So we ended up starting, led by myself with a professional services background, our own fund administration firm to administer these vehicles on behalf of the guys that we invested with. So it gave us insight, and oversight into what they're doing, and it ensured that it got done right and on time. And so we kind of had those two businesses between the pivot from lending to allocation. We kind of went from zero in both in 2011 to we ended up with 350 million of equity under management in the private equity real estate firm by the time I had exited and left that firm, and then $3.2 billion in assets under administration, all amongst these sort of I'd call sub-institutional real estate GPs, a lot of debt funds, multifamily guys, single family guys, self-storage guys, everything you can think of. And a big part of my role was just, I did a lot of consulting with the guys to help them get their capital structures right as well. So when you're doing that every day and trying to help them form their offerings to ensure that they're aligned and they're marketable, you end up playing the role of the LP, right? Because they'd say, well, I want it to be a 50-50 split or something or whatever they came up with. And I'm like, that's not going to fly. We wouldn't go for that. That's not going to work. And so I spent most of my days kind of in the seat of the LP, and not to mention running a fund administration firm. It's just every day it's about fairness and equitability, right? Like ensuring that everything's being done above board and in a fair and equitable manner. As you probably know, a lot of these documents, they're pretty vague, and could be interpreted multiple ways. And so just trying to keep these guys from not coloring outside the lines. So that's really in a nutshell, that's kind of my background, consultant, advisor, even keeled middleman type.
Yeah. So when you first started looking at deals in that space, or maybe even just over your tenure there, how were you going about finding operators to work with, and how did you decide what asset classes or strategy to pursue?
Yeah, great question. So we really used as our go-to-market was the advisory practice. So we knew a lot of guys that were sort of probably the most ideal candidates were the guys who were beginning to contemplate moving from single asset syndications to more blind pool funds. And so we used that as really our platform where we were saying, hey, you want to start a fund? We'd have webinars, whatever. And that attracted a lot of those kind of emerging sponsors, operators, managers to ourselves. So now, and once again, now we're being paid to conduct due diligence. At the time, we were charging guys like 50, 60 grand to walk them through the process. That included all their fund docs, modeling. So I had to do a modeling for them, pretty much everything soup to nuts to get them ready to actually go to market. But, so that was how that's how we sort of source them. In terms of like the strategies you like, the other interesting thing is when you're spending a lot of time with these guys like this and you're digging into not only them, but their strategies, you begin to pick up patterns of what intrigues you. So I think, for us, and this was like, in 2013, 2014, we started, realizing like multifamily was very attractive to us. And so I'd say we were somewhat early compared vis-a-vis to many others, right? Of kind of finding a few operators that were doing multifamily deals. So we did a lot of multifamily deals in 2013 through 2018 of just the value add variety. A lot of that was also in, I'll call it the Midwest. That was just our thesis. So we tended to stay away from the coast just because of volatility. We're pretty risk averse guys. We just wanted to go places where we just knew things weren't going to crash through the floor. Or it wasn't. We wanted stuff that we felt like the operator could really add the value, and go in and you get it at the right price and execute your plan and, get out and not to succumb to some other wobble that we couldn't foresee.
So you were very much on the just helping set up the fund, and you just kind of knew from an LP perspective what would fly and what wouldn't. How would you make those comments?
Well, like I said, because when you put yourself in the LP shoes, which we were, I mean, you now, that's where your interests lie, right? And so when it comes to like control rights or lack thereof, or, the economics, I mean, and once again, I mean, I think if anything, because my partner in that, I mean, he had been running an open-ended blind pool fund since like 2001 for the debt fund. In 2008, we ended up, launching a new fund that was open-ended and had a debt component. And so in my superpower individually is probably just the ability to learn things that are very complicated and abstract very quickly. And so, it just made sense to me, right? And so just understanding all of the securities laws, just structure, like what would it be aligned versus what isn't, just being able to put myself in the shoes of the different parties. Like, well, hey, if, and just being a fund administrator too, like I said, it's just, you got clients that are wanting to do things. And my job is to say, does this make sense? Is it fair? Right? Like you want to do this now, because some of these things are a bit zero sum, right? Like there's winners and there's losers. So my job is like, well, how do we make it so that it's more even both ways? So that's how I learned it. It was just using my brain and then saying like, well, if that were me, how, when it comes to like dilution and a fund with multiple closes, like, well, the value of the assets goes up. And if I came in early, but as investors, we use the same thing. So often we'd invest in other funds, and we figured out like, well, we're better off waiting until the fund's less blind. They've acquired assets and, hey, we like you guys, but we're not going to invest until the final close because you just so happen to not have a clause in there. There is no anti-dilution mechanism. There's no subsequent commitment charge. There's nothing. I basically come in and write a big check and I elbow the rest of you out and I own, 20% of the fund on, just by coming in at the end, and I dilute everybody else. I always said it to my clients. I'm like, no one really appreciates dilution until it happens to you.
What are these? Okay, this is fascinating. I mean, I actually have had something similar happen. I invested in an ATM fund, and similarly, I waited to invest until a good part of the fund was up and running and generating returns, so that when I invested very quickly, that I would be getting cash flow pretty much immediately instead of waiting for these things to be built, placed, and activated. But when I made that investment, I didn't find I didn't look for a clause like that. I just kind of instinctually was like, okay, I want to wait until this fund is up and running and get in at the last moment. What are those clauses that we should be looking for as investors to determine those types of things?
Yeah, I mean, the big thing, like those ATM funds, I'm familiar with. I actually helped the client set one up, a feeder into one of the other ones. But yeah, it's the clause you're looking for, right, is that there's multiple closes and assets are being acquired over time. And the and the ATMs are a bit different because they're sort of a depreciating asset, right? And so, in fact, that's how those funds sort of work. I mean, ultimately, those things will have, their useful life goes away. Whereas in real estate, it's appreciating, right? So that's the big thing is that, well, if these guys know what they're doing, they're going to acquire assets, and between inflation and just everything else, these assets should be worth more 30 days, 60 days, 6 months, a year, 2 years down the road than they were when they were acquired. So the clause you're looking for to answer the question, right, is that there's some sort of mechanism on subsequent closes after the initial close that something's going to happen. And typically in just like a regular institutional LP close-ended fund, it would be something called like a subsequent commitment charge, where the LPs that come in later basically have to pay like some sort of percentage back to day one, right? And when they do the close, so if the $100,000 is called in, they're going to send in $108,000, and $8,000 is going to then be distributed pro rata to the existing LPs, right, based on their ownership percentage prior to the close occurring, and then paid out as a guaranteed payment, right? So they're basically being paid. Now, once again, it's the same thing, is that usually it's like 8%, because many LPs coming in, if that subsequent commitment charge was 18% or 24%, they would just be like, no way, like this is ridiculous, and they'd object. Well, the reality is, well, if your fund's going to return, if your fund projecting an 18 IRR, then the subsequent commitment charge should really be probably 18, not 8.
Right.
So even then the dilution is occurring, and there's other ways to handle it, like a revaluation of the assets and have a fluctuating net asset value. So the first investors pay 1,000, or you see other things, which I did a lot too, is just to have multiple classes of shares that, could have a fluctuating, just predetermined, fluctuation. So there's many ways. That's why I call it like an anti-dilution mechanism. So you're just looking for something that's addressing that. To the degree that it's not there, then that means that you're going to be diluted.
Right.
So that's what it doesn't say.
So it's done either in a way by time or by closing or by maybe even capital invested.
Yeah, that's right. Yeah. And usually it's time. And then, like the capital invested thing is you'd say like, okay, we're issuing $3 million worth of Class A shares. So the first 3 million that's brought in will get, these shares. And once again, it could be a different split. Like you guys get an 80-20 split above a 10 pref, and then anyone who comes in from 3 million to 6 million gets. So there's lots of ways to handle it, right? And that was part of my job, is like I was told all my clients when I consulted with the operators and the sponsors, right, was like, listen, my job is so that you can defend whatever we come up with, right? If you're having a hard time explaining the subsequent commitment charge and the percentage, which most of them did, then I'm like, maybe we need to find a different way to get to the same place, right? Because I'm not selling it. Like I could sell it all day long, right? I understand it, but I'm not going to be with you. You're going to have to sell it on your own. And if you confuse them, that could be a problem. So it just always came down to that. It's like, this is your product. This is something you got to sell. You got to be comfortable with. You got to be able to defend it. No matter whatever it is, fees, the whole thing, you got to defend it.
You had a very unique perspective of helping sponsors put together funds for moving from syndications to funds. I imagine that for you, after having dealt with so many, it is probably easier to determine who is a sponsor that you would work with and invest with and who you wouldn't. What are those maybe subtle hints or trends that you learned over time? I mean, you did this for so long. I have to imagine it must be easy to pick out who you would invest with and who you wouldn't.
Yeah, I mean, I think it's a lot easier than it would have been had I not done that. I think the big one for me is just it comes down to the ability to provide me with information that backs up your claims within a reasonable time frame. And this could disqualify many people who maybe are good operators, right? But I've always taken it as that seems to me to be, of all the companies we worked with over all the years, when we sort of rested on that as sort of, and when we look at the winners, the ones who really perform well for us, that was evident from day one. And the ones who were, I'd call them swashbucklers, or, sort of like guys who are good at what they do, but it was a roller coaster going with them, right? Because of that, because they're just shooting from the hip and they know what they're doing and their instincts are right and they can shoot the gap, and but that's risk.
Right.
So to me, like that's a big one, is just like, if I'm going to ask you to provide me with this information, once again, if you don't have some of it, that's fine. Tell me that you don't, and, admit that it's just, you're disorganized or more disorganized than you want to be. But it's like, don't try to talk me out of it or say like, act like you're, that what I'm asking you for. And I can tell from talking with a lot of LPs, they always say to me like, you can ask for that stuff. And I'm like, why not? You know what I mean? Like why not? I mean, I'm not saying that they're going to give it to you, but I'm saying they better give you a damn good reason why they're not going to. You know what I mean? Like, what does that say about them? Because for me, I have no problem. You want to run a background check on me? Do it. You want to do, like, I don't care. You want to see my pro forma on a deal by deal basis? I don't care. You can see it. I'll give you everything. Take it all. What do I have to
like, you should be 100% transparent. There should be, like, you're taking on millions of dollars in capital. You, like, you should be at least that's how I feel. You should be as transparent as you possibly can. Show bank statements, like the whole nine.
That's exactly right. That's you nailed it. So for me, I'm just like, so you're telling me, I'm asking for bank statements. A great example. I'm going, well, anyone worth their grain is like, who doesn't have their own bank statements and can't present them, right? Like all this stuff I'm asking for, the fact that you think that it's hard to get means that makes me nervous, because it says, do you really know what you're doing?
Right. Or are you a good manager of capital?
That's exactly right. So it's just like, it's maybe I'm more detailed than you are, maybe when it comes to analyzing it that way, but it just says a lot about you. So I'd feel more comfortable if you had that stuff. And once again, like I said, it's your right to say that you don't want to, but don't make excuses. Just say, you know what? I could get it for you right now if I wanted to. I just don't want to. You know, it's like I can go find 5 other guys to give me the money and I don't need your money. Fine.
Yeah. Yeah. And ultimately you need to figure out, I think the key here is when you first get into investing, or at least this is how I felt, was if you don't have a lot of deal flow, you only have a couple deals to evaluate. And I think that's where this scarcity mindset comes in of, can I really ask for that kind of information? But if you flip it over and you say, look, there are so many deals out there, I'm starting to build a deal database right now, then you feel differently. If there's someone who is not willing to provide the information, then it's like, okay, I'm just going to go down the list. Do you have a list of sponsors in your mind of people who you really enjoy working with, and those who you don't? Like, do you have like a not to invest list, and why?
I do. Yeah. I mean, and I won't share their names, but yeah, I mean, most certainly. Yeah. I mean, most certainly, you know, and I mean, that was the hardest part about doing what I did, was that it was disconcerting, right? Like, you do it long enough to where you realize, like, the number of people that are probably worthy of your capital are in a very small minority, right? And that percentage just gets smaller and smaller and smaller the longer you do it. You know, and especially, and you see this with any kind of, you know, industry, or, you know, any run up in the financial stuff. It's just like when the market's going up, right? Like everyone looks like a genius. And I think the big issue is that, especially all those who got in, you know, to the real estate game, you know, post 2010, it's just, they all think that it was what they were doing was why they found success. Right. And where, to me, I'm going, even for us and our success, it's like, I'm not going to sit here and say we're geniuses, because we weren't, but at least we can admit it. You know what I mean? Like, in the second you convince yourself that you're God's gift to real estate, or that you got it all figured out, that's what makes me nervous. You know what I mean? And so I think that it just, the number of people, especially to navigate, you know, a down market and things like that, I just feel like it's just a smaller percentage of operators that can do it, because it's just different.
So you talked about, you very much helped operators who were doing individual syndications, so like one-off projects, and help them move over into this fund model. What were the biggest, I guess, hurdles that you found these operators running against, right? Like I'm just thinking, hey, as a prospective LP investor, you know, someone's done a bunch of 50 deals, maybe solo, one by one, and they're starting their first fund now. And I'm thinking about evaluating that as an investment. Like, what risks should I go in, like, knowing, and, you know, from your perspective, you've seen operators struggle with making that transition.
Well, I think the biggest thing they struggle with, right, is just the inherent complexity, that it's just more complicated, right? And so you have that, just like getting their minds wrapped around it, like, this is different than how we did it. And then the fact that they now have been given discretion, right, to make those decisions, which of course is the very thing that they want. But then that runs right up into fund management, right? So to the degree that they're able to convince investors to invest in their fund and overcome the complexity hurdles, right, meaning their ability to sell it, they then find themselves faced with that actual complexity, which is required then in fund management, right? Because now you're building a portfolio. And this is where I saw most of the guys it's just, this is what they really struggle with. I'm like, okay, we went and did all this modeling. We had all these conversations, and we put a buy box or an investment mandate around what you could or, what you can and you can't do. And now it's your job to build a portfolio that gets us to where you said you were going, right? That means that if you decide to do a deal, if you sold this and we structured it as an income and a growth fund, right, that's going to generate an 8% preferred return. That means that you can't go and do a bunch of deals that are deep value add that'll have no cash flow. Like you're going to have to blend some of these. You're going to have to find some of these lighter value add deals with sooner cash flow, right? That's your responsibility. That's called fund management. That's how you're getting paid that 1.5% or 2% fee, is to do that, right? Is to create this financial product and actualize it. And that's where many of them, it's just like, I could say that till I'm blue in the face, right? But until they experience it, then they realize like, oh my gosh, this is what you meant. I didn't understand it. Like, what do I do? Because I'm going, what did you do? Like you bought a bunch of deals like that. What did you expect? And everyone's upset with you. And I'm like, what part of this didn't you understand going into it?
So let me recap. So it's essentially when an operator is doing one-off deals, it's easy to underwrite what that one deal will do. What kind of prefs there should be, what the splits should be, exactly how that needs to perform. That's easy to do when you have one deal in front of you. What's different about the fund model is now you're relying on that operator's know-how to be able to somewhat predict with what kinds of properties are going to come their way and roughly how many. It's not just like, I look at 100 deals and I go find my one deal. It's like, no, I look at 100 deals and I need to have one lighter value and one deep value. And I need to understand that concept going in and know that I'm looking for, like, there might be 10 deals I would have done that are deep, renovation, but I have to say no because the way I've decided to structure the fund of what I sold to our investors.
Yes.
And that seems to be the stretch.
Yeah. Yeah, that's right. Which sounds silly when you say it out loud, but it's, and a good example is like this industrial fund, this Class B industrial fund I'm raising for, right? So it's, I wanted it to be monthly income, right? But with good upside. So I wanted to have my cake and eat it too. And that was driven because we were seeing deals like that, but we knew going into it. So it's a $15 million raise. We're like, we might only see 5 of these deals a year. Right. So that means, but it shrinks the whole universe, right? So you get deals on your desk, 2, 3, 4, 5, 6 times a week, right? But when it comes in, it's like, well, here's an 8 cap deal. We think we can get financing at 6. We're immediately like, it doesn't work, right? Like this deal won't work, or these leases don't expire for 10 years or whatever it is, So what happens is when you structure the fund, then you basically are disqualifying a whole set of deals, which of course they were paying me to help them through. I asked them the questions, they made the decisions. Right. And then they violate them. Whereas for me, I architect my own fund and now I'm basically saying this doesn't fit. So when I go find a deal, it's a really strong cash flow providing deal, then I'm like, this is a great deal. It's a 5-year deal and this thing's going to generate and kick off day one, 11% cash flow. It's a sale leaseback, right? So I'm like, this is a perfect asset, $10 million, $11 million deal, seed the fund day one. Now we've got a 5-year deal that's going to anchor me with good cash flow in my target range. Right. And then you do another deal and now you might be able to, as you go along, you might be able to do deals that are a little lighter on the cash flow because you've got enough of it coming from another deal. Right.
Let's throw out this scenario. I'm sure there are listeners out there that have someone that they love doing deals with, and they've invested in a couple of their individual projects or syndications. And like it seems everyone and their mother is starting to raise a fund, they now need to evaluate, okay, I like this guy. Should I go into his fund? What are the questions that someone in that situation should be asking their favorite sponsor?
Yeah, I mean, the first thing I would start with is just maybe it's obvious or not, but I mean, I'm always looking at it like what I just said. Do you think that you're actually going to see enough deals that look like this? Right. So I'm always, when I'm reading a PPM for like a blind pool fund, I'm looking for what's the mandate, right? With the investment mandate, meaning what can you do? What can't you do? How the buy box. And if it's super wide, then I'm going to be turned off. Like if they can just do whatever the hell they want to do, that's going to make me nervous. Right. But if it's, the more narrow it is, then I'm going to be coming down like, can you actually find enough of this stuff? Like, is there enough of stuff that looks like this? Does that make sense? So those are questions you want to understand is like
how many of those things have you seen in the last year?
You got it. That's exactly right. Like what is your deal flow on this kind of stuff? What does it look like? Are you seeing stuff like this for real? I mean, so you could actually do enough of this stuff for it to make sense. If you were able, if capital wasn't a constraint. So those are the things that I want to understand. And once again, I'm going to probably spend more time on just like, okay, what does your back office operation, like who's behind this thing? So like if you engage a fund administration firm, somebody who does this for a living, I mean, and I would want that because I want that to be the answer. Right. And if they're like, oh no, Sally, Sally's doing it. And we've known her forever and she's great, and I'm thinking to myself, you're a real estate guy, your ability to assess whether someone's a great accountant. I'm sorry. I'm just probably not going to accept that. Once again, but this is from my own personal experience.
Right. Yeah. You coming from that fund world.
Sally was. Yeah. I'm going, everyone who said their Sally was great, I basically within an hour figured out that they weren't so great. So, it's just making sure that do you actually have, it doesn't have to be your own employees, but I'm just
so let's dig into that. Like, so you came from that world where you were literally in the fund admin world. So what would be like an example of something that Sally did or didn't do that are just brass tacks, standard in your world? So
I mean, I think that and this is the thing I learned in my first business, which was IT services, whatever. But like we were on cash accounting, and then I just it's like revenues going up and down like a toilet seat. You can't figure out if you're profitable, and that was like one of my first big problems to solve was like, what the hell's going on here? And then, my CPA, whatever, is like, it's called accrual accounting, so, realizing that there's just a different way to keep your books, right? So that everything lines up. So, I mean, for me, that's what I go after right away is like, does this person does this accountant or controller or bookkeeper, whoever they are, it's like, do they actually understand accrual accounting? Do they understand that like, we're trying to keep all the right expenses in the right month and not doubled up. And, once again, to me, it seems basic, but it's just things like that. Do they have someone that can answer those questions? I don't care what you call them, bookkeeper, controller, CFO. It's just who there that actually has real competence, isn't just a glorified bookkeeper, right? And that understands, or how you can get the property level financials. Cause I'm sure you've seen it as well. Like in multifamily, a lot of these, they're property managers who are responsible to prepare the financials. They're busy leasing. Like that's their competence. Right. And so to me, it's just the accounting and the bookkeeping piece is usually the Achilles heel. And it's only exacerbated when you go into a fund model, right? Because now you've got individual properties. And if you can't figure out how to close the books on an individual property in 30 days, then how are you going to be able to close the individual books on 12 or 15 or 20 properties that all have to roll up? Right. And that's where some of the opaqueness is in these funds. Right, is the fact that these assets are held at book on the balance sheet, right? So you only know how their operating performance is. You don't necessarily know, and we've seen some of this stuff of late, right? Like these big syndicators and stuff. Like you just can't tell as the LP whether or not this stuff is really performing necessarily, right? And so it's just that's the stuff that drives me crazy is that I want to see that you can actually provide me with that kind of information. The operational metrics at the property level, the financial data that can roll up to the fund, so that if you know what you're looking at, you can actually figure it out. Because some of this stuff gets really wonky. I have clients come to me who try to administer their own fund, and it's just like looking at the balance sheet. I'm just like, dude, this is terrifying. Like, but they don't even know it. They can't even see it. And I'm looking at it like this balance sheet is not telling the story that you want it to tell. Do you not realize that? Right? You look like an amateur. What?
Yeah.
Sally's great. She knows what she's doing. I'm like, no, she doesn't.
What was you eventually then transitioned into industrial real estate, and that's where your focus is now. Why did that transition happen? And tell me a bit more about like why that niche.
Yeah. So, I mean, once again, going back to like the advising, like I spent probably 50-60% of my time client facing, the other 40% running the company. But, so once again, having the ability to meet with all these guys doing all these different strategies. And like I told you, there's a very small percentage that I'm like, these guys are winners. And once again, and we invested in many of those ourselves, through the other side of the business. But, the guys that had as clients that were doing industrial, I was always fascinated by it. One, because to me, it just seemed really simple. I'm like, this is great. Like, this is simpler than any of this other stuff. Right. And it just makes sense to me. So I've always had an affinity for that. And I always like mobile home parks as well. But I knew that it's much more labor intensive. And it's probably because I spent much of my childhood like in a mobile home park. So I just had a soft spot for it. But so that was, kind of the driver for industrial. But once again, going back to the quality of the operators, my partners are a father and son tandem, Andy and Mac Dumke, and they're from Oshkosh, Wisconsin. And so they were one of my clients. They were buying low income or affordable housing, Section 42 housing after the first 15-year LURA expires. Because Andy, the father, did a bunch of development themselves, and they realized like, let's buy the stuff when the first 15-year expires, hold it for another 15. They hired me to help them put together a fund for that. So, I spent quite a bit of time with them. And of course, I'm from North Dakota, they're from Wisconsin. We hit it off. And this was, 3 or 4 years ago. So when I ended up leaving both of these companies, I had the same partners in both of the fund admin company, and we pivoted to a tech platform, with a marketplace and investor portal and all this stuff. And a falling out. I was partners with these guys for 14 years. We just didn't see eye to eye on how to capitalize the firm. So I left. And a bunch of my former clients started calling me like, hey, what are you doing? Like, hey, you want to help us out? So Andy and Mac, came back and said, hey, can you help us? We're trying to raise institutional money for this LIHTC housing deal, realizing it's brain damage, to do this, from high net worth investors. I'm like, yeah, I'll help you out. And then they started telling me about their industrial deals that they were doing. And I'm like, guys, how many of these deals are you seeing? Once again, and Andy, the father's been, pretty successful over the last 25 years. So they were just doing deals. He kind of shifted from retail and was divesting and started doing these Class B industrial deals, more of them. I'm like, these are freaking home runs, guys. So I'm like, why don't you take some outside capital? I'm like, how many of these deals are you turning down? They're like, I don't know. I mean, maybe one every 2 or 3 weeks or something. I'm like, let's just put a fund around this. And, cause they were just shucks Wisconsin guys. So they just have never really liked interfacing with, the investor side. I'm like, listen, you guys do your thing. I'll do my thing. I think we make a great team. They agreed. And so it was like the love of industrial to begin with, the fact that they were doing them, kind of had the tiger by the tail. I'm like, this is great. And frankly, after just being on the other side of the table all the years, like I've had a desire to move to the operator side of the table. It's kind of like you've been there, done that. And it's like, I want to get my hands dirty.
Totally.
And I've enjoyed it. And I do. I like it a lot. It's fun being on the operator side. And I kind of live vicariously through all those guys all those years. But it's just, I knew why they loved it. And I was calling them deal junkies. I'm like, you guys are just deal junkies. But I'm like, I'm a deal junkie too. Like, I love that. It's so fun.
Same. So when you talk about like slam dunk deals, like walk me through the strategy of the fund. Like where, Heartland, and give us the like buy box.
Yeah. So for us, so the buy box is really at 5 to 20 million purchase price, too big for the small guys and probably too small for the big guys. And we're looking for,
so big guys, meaning like the BlackRocks,
and even larger, just the guys who, if it's under 20 million, it's just not worth it,
and so, small guys, we're talking like, people that do development, but they just don't have a team around them,
or a dentist, or a small business owner, these guys who just buy stuff on their own, like the guys who do a lot of the triple net stuff, it's just, they might go up to 5-6 million, but they're not going to touch, this kind of stuff. So just kind of weed out the competition. And then for us, it's really we're looking for, 100,000 to, 500,000 square feet. High quality construction, Class B stuff. So obviously it's probably been built in the last, 20 to 30 years, right? So it's not the newer stuff, but
in multifamily, there's this Class A through D. Class A is luxury, highest paying. You're paying $2,000, $3,000, $4,000 a month in rent, and C is like a neighborhood being regentrified. In the world of industrial, how do you describe each class?
Yeah, same thing. So Class A is the newer product that's closer to large urban areas, right? So it's just newer stuff, more of the technology baked into it. All the Amazon distribution centers, all the stuff you read, Prologis, that kind of stuff, and it'd be stuff that you drive by on the freeways in and around Houston, right? Whereas interspersed in there, you're going to find Class B buildings, and they might be in great areas too, but they're just older, right? And so that'd be kind of Class B, or it could be Class B. It's a really nice building, not kind of Class A amenities, grade, but it might be in a secondary market, or even a tertiary market. And then it's the same exact thing. And then Class C, and a big thing is when you kind of go down classes, it's ceiling height. That's the ceiling clearance is the big one. And the number of doors, loading doors, things like that, those kinds of amenities.
So talk to me. We're talking like Class A has at least 20-foot ceilings and, 10 doors per
32 plus, and so Class B would be, the same. You're looking for, and it could vary throughout the facility, right? Depending upon the areas. But yeah, off the loading docks, you're looking at 26 plus, feet of clearance up to, and up. But in some of the older ones, we'll call it Class C or Class D, they might be 20 foot heights. So it just doesn't work, right? For racking and for warehousing. So it's like any of this stuff. It's just now your number of potential tenant types is reduced. It increases risk. So, some of the facilities we look for, we like, cold storage, is for some of the space, things like that. Those are amenities that, there's just not enough of.
Cold storage, like you mean air conditioned or
like freezer space, freezer space. And that's a big part of it, right? And it's just hard to find. Like, where do you store the stuff? If it's just a dry storage, it's just, it's all climate controlled, things like that. But the big things when you're evaluating and assessing the building itself, right, is the condition of the roof is the biggest. So, because a roof on an industrial building, it could be $1 to $3, $4, $5 million. I mean, it's a deal killer, right? In the parking lot, stuff like that, and the building construction. But
so what I'm hearing here is, so you're going in and you're looking for Class B. So, warehouses or, I guess industrial facilities that have like high ceilings, 32 plus, the higher the ceiling, the better, a little bit older, maybe in primary, maybe in secondary markets. And then you're looking for things that either, you get a cutback, or I forget what that term is called, where you get a credit for the roof if it needs repair, or that the roof is in good condition. And then you're looking for what kinds of tenants. So you go in and you do a value add component, you just release like
value. So we would consider value add as re-tenanting, right? So we're looking for buildings that have expiring leases that are well below market, that are at least 20% below market, expiring 12 to 24 months from the date that we acquire it, is sort of what we're looking for. So I mean, those are the big things. I mean, the other thing too is just we want it to be close to interstate highways, things like that. If it's in a secondary or tertiary market, just once again, it's just the number of people that are going to want to lease that building. But it's most of our value add is all about re-tenanting or renewing leases, and that's how you add the value.
So most people that I know, and they exactly fall into this category that you're talking about, like the the dentists, physicians, people that are buying these smaller triple net leases, and they typically like to buy them with long-term leases in place because those people don't have the expertise to, go figure out and how to refill those tenants.
Got it.
So, flag here, there's risk with having these leases expire in the next 12 to 24 months. Walk us through the process of, you've clearly identified an expertise here in how you go find people or why you're comfortable with that risk. Maybe walk us through why, like the process that you use to make you comfortable.
Yeah, and you nailed it. And a lot of times, the current owner has probably owned it for 15 years, and they're afraid that this deep recession's upon us, and that their tenant's gonna leave them, and so they're basically like, "Let me get out before it gets too bad." Well, we like that. We want them thinking that way because then we get it on sale. But yeah, I mean, the reason why is because we have such strong relationships within our target markets in the broker community. So our broker is the number one industrial broker in the country. So he does more business than any other industrial broker in any of the other areas. And his team, this guy's got his own private plane. Out in the Midwest, once again, you kind of have to. He's got to get to these different places or whatever. But nonetheless, he's a successful dude, and he's built a team of guys that are sharks. And so because my partners have done so much business with them over the years, they like them, and I think that's just it, not to be overlooked in this business. It's a relationship business. And so, I think that's really the key for us. It's just those relationships are in place. And when it comes to tenant types, especially the facilities that we target, we're usually targeting more national, credit type tenants. This isn't Joe's fencing company, we're looking at larger, more, maybe not institutional credit quality, but like one of the buildings we bought in Ohio, it's Precision Cast Parts owned by Berkshire Hathaway, was the tenant, so tenant, like the roof matters to the quality of the building. And it's very important. The tenant is the most important thing, right? Because if it is Joe's fencing, hey, I love Joe's fencing. I want to see him be successful, right? But let's face it, if Joe's fencing is the tenant, even if it's a 10-year lease, that's just riskier, right? So I'm going to pay less for that building. So our whole thing is how can we find a building? And we do this at times. We tie up a property, try to get our DD period, to be as long as it can be. And then we go and hunt for tenants, or you already have them in tow and have leases signed. It could be a vacant or partially vacant building, and we already have leases. And, so we're basically forcing appreciation before we ever even close. Like the deal we're doing, 300,000 square foot building in Madison, Wisconsin. That's what we've done.
So walk me through. You get this broker, that you've built this relationship with. He calls you. He says, "Hey man, here's this property that's coming on the market." Maybe he sends you an email with the details, and then you turn around and you start calling. You have a list of maybe 100 national players that you're.
Yeah, if it might be people we know, or he, in this case, he's so here I've got the building and I have a tenant. I think, in fact, I've got maybe 3 tenants who want this thing, right? So it's basically he's bringing most of the ingredients to the table. Then it's just a matter of us, negotiating with them. Right?
So why doesn't someone like that take the deals themselves?
Well, some of the deals he invests with us or whatever, but I think that's just it with brokers. It's just they know, it's don't bite the hand that feeds you, right? It's just
he makes his commission.
Brokers make good money. If you're good, you make good money. You're making 3% on the buy, you're making 5% of the lease commissions. Once again, these guys are raking it in if you're good. Yeah. So taking away buildings when you could turn them over and make that money, it's just different. Right. It's not to say that one day this guy couldn't go on his own and, source his deals. And obviously that's a risk to us. But it's like anything. It's just, you go find it. And I think it's all this stuff, everything in this commercial real estate game. It's all about broker relationships. You need to know who the boots on the ground. I mean, these are the people that are in the ears of people. And yes, you can develop an acquisition strategy that's an off-market strategy to augment. You know what I mean? If you need to basically go and target owners, like a lot of mobile home park guys do. I know multifamily guys do that. We could do that as well. And we may at some point, but when you've got guys that are just like handing you deals, I mean, they're ahead of us. And in many cases, the brokers are. They're just more established, and it's going to be hard for you it'll take time for you to sort of get more embedded than they are.
Yeah, no, I get that. Lance, this was awesome. I super appreciate you coming on and sharing everything with us. That was awesome.
Yeah, my pleasure, man. Yeah, anytime. Happy to join you. And
where can people go find you?
Yes, I mean, LinkedIn is probably the best. So just Lance Pederson. It's Pederson on LinkedIn. Feel free to connect with me there, and we can go from there. And we've got a website. It's resonance-cg.com. But I think LinkedIn's the best place if you're listening to this, and happy to talk with anybody and answer questions. Value before you expect value in return. But that's how I operate.
Awesome. Thank you so much, Lance, and see you all on the next show.